Hello everyone, my name is Akash Shashikun Notable and my roll number is MB24033. Today here I am going to present a topic on components of financial statements. First of all, component of financial statement. This presentation will break down the essential components of financial statements, exploring each element and its significance in understanding a company's financial health. What are the components of financial statement? That is, number one is a balance sheet. In balance sheet include assets, liabilities, and equities. What is a balance sheet? First of all, a balance sheet, also known as a statement of a financial position, is a financial statement that provides a snapshot of a company's financial condition at a specific point in time. It details the company's assets, liabilities, and shareholders' equity adhering to fundamental accounting equations. What are the components of balance sheets are assets, the resource owned by the company that are expected to provide future economic benefits. Assets are typically classified into current assets and non-current assets. Current assets like assets likely to be converted into cash or used up within 1 year, such as cash and cash equivalent, accounts receivable, inventory, and prepaid expenses. Non-current assets, long-term investment, not expected to be converted easily converted into cash within a year, including property, plant, equipment, intangible assets like patents and trademarks, and other long-term investments. Second is liability. Liability means the obligation the company owes to external parties. These are also divided into current liability and non-current liability. Current liability are debt or obligation due within 1 year, such as account payable, short-term loans, and accrued expenses. And non-current liability means the long-term obligation due after 1 year, including long-term loans, bond payables, and deferred tax liabilities. Now, the shareholders' equity, the residual interest in the assets of the company after deducting liabilities. It represents the owner's stake and is composed of share capital, fund raised by issuing shares to the investors, retained earning will accumulate a net income that has been retained in the company rather than distributed as a dividend. So, the balance sheet is a crucial tool for an investors, creditors, and management to assess the company's financial health, liquidity, and capital structure. By analyzing the balance sheet alongside the other financial statements, stakeholders can make informed decisions regarding investments, lending, and strategic planning. Now comes the income statements. Income statements, also known as a profit and loss statement. It is a financial document that summarizes company's revenue, expenses, gains, and loss over a specific period, such as a financial quarter or a year. It provides insight into a company's financial performance, indicating whether it achieved a profit or incurred a loss during the time frame. Some of the key components of income statement are revenue. Revenue is the income a company generates from its core business activity like sales of goods and services. And expense are the cost incurred by a company to generate revenue, including salary, rent, and utility. And net income is the bottom line, representing the profit and loss after deducting expense and the revenues. So the financial statement is essential for the stakeholders, including investors, creditors, management, to assess the company's profitability, operational efficiency, and overall financial health. By analyzing the income statement over multiple periods, stakeholders can identify trends, measure performance against industry peers, and make informed decisions regarding investments, lending, and strategy initiatives. Now, the cash flow statement. Cash flow refers to the net movement of cash and cash equivalent in and out of a business over a specific period. It provides insight into a company's liquidity, indicating its ability to cover expenses, settle debt, and invest in a growth opportunity. The key components of cash flow are operating activity. Cash flow operate represent the cash generated or used in company's day-to-day active operations. Investing activity. Cash flow investment activity represent the cash used or generated from buying or selling a long-term assets like property, plant, and equipment. Now, third, the financial activity. Cash flow financial activity represents the cash used or generated from activity related to financing like borrowing, issuing stocks, or paying dividend. The comprehensive understanding of a cash flow is essential for assessing a company's financial health as it highlights the actual cash available for the operations, investment, and financial activity. Positive cash flow indicates that a company has more cash coming in than going out, enabling it to meet the obligation and pursuing the opportunity. Conversely, negative cash flow suggests that a company may struggle to cover its expenses and sustain the operation. So it's important to distinguish between cash flow and profit. While profit represents the financial gain after all expenses have been deducted from the revenue, the cash flow focuses on the actual inflow and outflow of a cash. A company can be profitable on paper but still face a cash flow challenges if its revenue are not collected promptly or if its expenses are not managed effectively. So regularly monitoring and analyzing the cash flow helps business to ensure they have sufficient liquidity to operate effectively and make informed financial decisions. Now equity statements. Now beginning equity represents the owner's stake in the company at the start of the reporting period. Then net income. Net income from the income statement is an added to equity as it increases the owner's stake. Dividends. The dividends paid to shareholders are deducted from the equity as they represent a distribution of profit. Now ending equity. Ending equity requires the owner's stake in the company at the end of the reporting period. Of reporting requirements for assets. Recognizing criteria. Asset must meet a specific criteria to be recognized on balance sheet, including control and future economic benefit. Of measurement biases. Assets are typically measured at the historical cost, which is the amount paid for the asset at the time of acquisition. Disclosure requirements. Company must disclose the information about the assets, including their nature, valuation, and any impairments. Valuations and depreciations of an assets. Valuation like useful life. The useful life of an asset in the period over which it is expected to generate economic benefit for the company. Salvage value. Salvage value is the estimated residential value of an asset at the end of its useful life. Third is depreciation method. Depreciation method are used to allocate the cost of an asset over its useful life, such as a straight line method or accelerated depreciation method. Valuation and depreciation are the fundamental concept in accounting and financial, essential for accurately representing the worth and wear of an assets over the time. Asset valuation is the process. Asset valuation is the process of determining the fair value or the present value of an asset. This assessment can be applied to various assets type, including tangible like machine, real estate, as well as intangible assets such as a patent and trademark. Several methods are commonly employed in an asset valuation like cost method, market approach, and income approach. The choice of valuation method depend on the assets type, availability of data, and the specific contents of the valuations. Now, depreciation of asset. Depreciation is an accounting method that allocates the cost of a tangible asset over its useful life, reflecting the asset consumptions with wear and tear or obsolescence. This systematic allocation ensures that the expense recognized alike with the revenue generated by the asset. Common depreciation method includes straight line depreciation, declining balance method, double declining balance method, unit of production method, and some of year digital are the some of the basic depreciation methods. A modified approach for infrastructure assets like reduced depreciation, assets life. The useful life of infrastructure may be extended beyond the traditional depreciation method. Focus on condition. The condition of assets rather than just its age is a key factor in determining its useful life. Maintenance. Regularly maintaining and repairing are essential part to prolonging the life of the infrastructure of an asset. The financial thus I hereby conclude that the financial statement provides a comprehensive picture of a company's financial health. Understanding their component is crucial for informed decision making. The key takeaway includes the importance of assets, liabilities, and equity in representing a company's financial position, while income statement and cash flow reveals its operational performance and liquidity. Thank you.